We all use banks, right? For our paychecks, paying bills, maybe even saving up. It feels like the ultimate safe place for your money. But with everything going on in the world, you might be asking, is keeping my money in the bank truly risk-free? Or are there hidden dangers we're not talking about? Well, today, we're diving deep into that question. We're going to break down the potential downsides, the risks you might face keeping your cash in the bank. Stick around, because understanding this could totally change how you think about managing your money. Let's start with the stuff you need to be aware of. The potential downsides of keeping your money in the bank. First up, and this is a big one, especially these days, inflation. Inflation is basically how much the cost of things increases over time. Think about those little price hikes at the grocery store. That's inflation at work. When the rate of inflation is higher than the interest rate your bank pays you, your money actually loses value over time. It buys less in the future than it does today. Current accounts, where most of us keep our day-to-day cash, often pay very little or even zero interest, sometimes even charging fees. This makes them super vulnerable to having your money's purchasing power eroded. Imagine you have $10,000 earning 1% interest. You get $100. But if inflation is 2%, you'd need $10,200 next year to buy what $10,000 bought this year. That 1% interest didn't cover the loss in value. Historically, events like the Great Inflation of the 1970s to early 1980s show just how much this can hurt, significantly reducing people's ability to buy things and their standard of living. Okay, next potential risk, bank failure. Banks work on something called a fractional reserve system. They lend out a huge percentage of the money deposited with them, often 90% or more. This makes them inherently fragile and vulnerable if their loans go bad, their investments tank, or crucially, if too many people try to withdraw their money at once. This rapid withdrawal is known as a bank run, and it can quickly deplete a bank's liquid cash, potentially leading to failure. We've seen this happen. A run on deposits at IndyMac Bank in 2008, the massive failure of Washington Mutual, also in 2008, partly due to a run. And more recently in 2023, we saw the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. Now, you might say, but what about FDIC insurance? And yes, that's a massive protection we'll cover in the pros section. But there are nuances and potential risks even there. While deposits are insured up to a standard amount, usually $250,000 per deposit or per insured bank, money above that limit is uninsured. If a bank fails and isn't quickly bought by another, recovering those uninsured funds is not guaranteed. You become a creditor, and recovery depends on what the FDIC can get by selling off the failed bank's assets. One economist even argued that for money earning zero interest, the slightest chance of a delay or loss, even for insured funds in a widespread severe crisis, could make keeping it in the bank less appealing than alternative options. The FDIC's fund, while backed by the government, holds significantly less than the total insured deposits across the system. Moving on, there is the cyber attack risk. Banks are prime targets for hackers. Financial institutions are significantly more likely to face cyber attacks than other types of organizations. While consumers are legally protected against unauthorized transactions if they report it quickly, usually within 60 days, sophisticated large-scale attacks are a concern. These can lead to direct theft, but also massively increase costs, damage customer trust, disrupt operations, and some experts worry a major attack could even threaten a big bank's ability to stay in business and its solvency. Cybersecurity is a critical part of a bank's operational risk management. We've seen significant attacks like the $81 million stolen from Bangladesh's central bank in 2016 and over $31 million from Russia's central bank. State-sponsored attacks are seen as a major threat to U.S. banks. So that covers some of the key risks: inflation eating away value, the small but real chance of a bank failure, risks for uninsured deposits, the potential for delays, cyber threats, and even the possibility of being charged to save. Now let's flip the script and look at the major reasons why, despite those risks, keeping money in the bank is widely considered safe and necessary for most people. The absolute biggest protection comes from government-backed deposit insurance. In the US, this is primarily the FDIC for banks and the NCUA for credit unions. This insurance is automatic when you open a deposit account at an insured institution. It covers your deposits up to the standard limit of $250,000 per depositor, per insured bank, for each account ownership category. And here's the key. This coverage is backed by the full faith and credit of the United States government. This is a powerful guarantee for the vast majority of depositors. Related to that, the system is designed for prompt access to insured funds in a failure. The FDIC is set up to act quickly. Their goal is to return your insured money, including principal and accrued interest, up to the limit, typically within 2 business days of the bank closing. Often, regulatory actions result in a smooth transition that minimizes disruption for customers. When a bank fails, regulators like the FDIC step in. Frequently, the failed bank's operations are sold to a healthy bank. When this happens, your account is usually transferred seamlessly. You might just get a new debit card or statement from the new bank, often without even realizing the old one failed. Even if a bank isn't acquired and is dissolved, there is potential for recovery of uninsured funds. While not guaranteed, depositors with more than the insured limit can file a claim with the FDIC as the receiver. Recovery depends on liquidating the bank's assets, and in some specific high-profile cases like Silicon Valley Bank in 2023, the FDIC did provide full reimbursement for uninsured deposits, funded by fees on banks, not taxpayer money. As we mentioned the cyber risk earlier, it's important to remember the legal protections against routine cyber theft for consumers. U.S. law protects consumers against unauthorized transactions from typical cybercrime. If you report it promptly within 60 days of it appearing on your statement, the bank is legally required to refund your money. Banks also employ robust risk management practices. Financial institutions have comprehensive systems to identify, assess, and manage various risks, including credit, market, operational, like cyber, reputational, liquidity, and compliance risks. They use tools like cash flow forecasting, stress testing, internal controls, and strong cybersecurity defenses to try and prevent failures and protect assets. They even work on institution-wide risk governance. For those with significant wealth, there are strategies available for protecting funds above limits. You can ensure all your funds are insured by spreading deposits across multiple different FDIC or NCUA insured institutions, keeping below the $250,000 limit at each. And let's not forget the most practical point. Banks are a necessity for day-to-day transactions. They are fundamental for receiving paychecks via direct deposit, paying bills online, using debit cards for purchases, and accessing cash. You can't really function in the modern economy without using a bank for at least some of your money. So, while keeping your money in the bank isn't without its potential risks, inflation can erode value, failures can happen, though rarely impact insured funds. Uninsured balances are vulnerable and cyber threats exist. It also offers significant safety nets and essential convenience. The FDIC and NCUA insurance is a powerful government guarantee for most depositors. The system is designed for quick access to insured funds. And in many cases, failures result in smooth transitions. For the average person, keeping their emergency fund and day-to-day cash in an insured bank account is still the standard advice and generally very safe up to the $250,000 limit. Being aware of inflation means considering other options like higher yield savings accounts or investments for long-term savings that you don't need immediate access to. And if you have significant funds above the limit, strategies exist to keep it all insured. Ultimately, whether keeping your money in the bank is safe enough depends on your individual financial situation, how much cash you hold, and your risk tolerance. But hopefully this breakdown gives you a clearer picture of both the potential pitfalls and the strong protections in place. What do you think? Has understanding these risks changed how you feel about keeping money in the bank? Let me know in the comments below. Don't forget to like this video if you found it helpful and subscribe for more insights into the world of finance. Thanks for watching, and I'll see you in the next one.